Welcome to today's short video. We're looking at 5 secrets to developing your trading edge. Trading edge is something that we often hear people talk about, and yet it's poorly defined usually. And the practical advice relating to it are often vague. So in this video, we're going to give you 5 things to have a look at that can help you develop something that can be very special in your trading. So let's start fairly obviously by looking at what a trading edge actually is. Traditionally, it's been described as having some sort of advantage over other market participants. And it's often attributed to a system or a system nuance that you've specially developed, but it's so much more than this. And in this video, we're going to look at some of the things that can contribute to this edge. In simple terms, arguably, if you have a plan, trade it and evaluate, well, that gives you an advantage over perhaps up to 80% of traders, because most people don't have a great plan, rarely trade it, and don't measure it. But we can even do better than that. The trading edge, by definition, can be described as a consistent testable advantage that improves your odds of trading success over time. It's not about how you compare to anybody else, if we're completely honest. It's about how that account looks today versus in a month's time versus in 6 months' time, surely. And it's a combination of generating good ideas, market timing, managing risk, execution, not just entries, which again occupy just such an incredible amount of energy and effort. Once again, it's so much more than that. Without an edge, you're relying on luck, not skill. Results will be random or just plain average. What I want for you is that you put the right things in place, that in weeks and months and years' time, you can say, well, that was worth it. That was worth all the effort that I put in those early days, or even not so early days, in many cases, of course. Let's give you a simple example. Even if you have a system that wins only 48% of the time, it uses a 2.5 to 1 reward to risk ratio, still produces great long-term profits. This focus on having a high win rate isn't the difference between creating something that's very profitable on an ongoing basis and something that's not. So let's look at our 5 secrets. Our secret number 1 is that an edge is built, not found. It's not something you get by accident. It's not something that you get from a YouTube video or even a great course. An edge is built over time and is internal. There's no magic system. You've got to do the work because an edge comes from testing, refining, and aligning with your strengths as a trader. We're all slightly different in terms of not only when we access the market, but how we access it too. You must create and implement strategies that fit your daily routine, your tools, your trading purpose, and of course, emotional style. There is no room for removing emotion out of trading. I want you to be emotional about your trading. Make that emotion channeled. I want you to be enthused when you do well because you've done what you should have done. I want you to be disappointed that you could have done better. That's all emotion. We need it to give us the driver to move to do those things we should do on a consistent basis. Copying others gives you their trades, but not their conviction or context. And interestingly, copying others rarely gives you their results either. Stressing, of course, this individual nature of trading. Here's an example. A trader working full-time builds a 4-hourly chart trend model to match their schedule and avoid intraday noise. That's logical. Secret 2, probabilities are only as good as your data. When we talk about data on which to make decisions, this can be test data or live data, i.e. that which you record, journal, and download. Poor data creates false confidence. If you don't become a significantly talented and committed record taker, then you're never going to be able to develop true confidence in your results. Strategies which are robust, and you'll continue to live in a place where assumption and guesswork are as important as anything else. And again, we want to do better than that. Sample size matters, as I've talked about in other videos. You've got to have a critical mass of trades to make decisions on. 10 winning trades is not enough to create more than a strategy. This becomes more acute when we start to split into instrument type, strategy type, etc. So if you have 40 trades, you would imagine that that's good. But if you're trading 4 different strategies across 3 different instruments, then all of a sudden that becomes quite diluted. So, of course, you need something to start to work on, but then that measurement must be consistent. It must be continuous. And starting to measure market conditions during that testing is needed to match your live environment. So it might be that your mean reversion strategy works great in markets that are trending, but falls flat if markets are in strong trend. But you'll only know that if you start to record the market conditions during taking those particular trades. Secret three is edge dies without execution discipline. Unless you follow the system that you have, no matter how good it is, no matter how great that strategy is, if trades are skipped, rushed, or mismanaged, you're not going to get that edge that you can do that's within your grasp. Emotional interference like fear and revenge will kill performance, even with good setups. Remember, it's not just about entry, although most of our focus is often on entry strategies. The reality is that most mistakes that traders will make will be subsequent to entry. It's so often about exits. And many traders who have been in the market some considerable time would stress that exits are as, if not more important than entry. It's consistency in execution that brings your edge to life. A good example of this is what we tend to do when we've had a few losses in a row. So perhaps after two small losses, a trader hesitates on trade three, which turns out to be a textbook winner. And of course, because of that pause, because of that lack of confidence, because of that execution discipline issue, and ultimately those three trades together don't look anywhere near as good as they could have been. Secret four is psychological biases sabotage the best edges. We've talked many times before, both webinars and previous videos, on cognitive biases. These biases, like loss aversion, fear of missing out, or FOMO, and overconfidence, distort decision making significantly at the point where you're about to press the button. So I hope that you're getting the message through all that we're talking about today is that most edge erosion happens in the space between your ears. Nothing to do with the market, nothing to do with the Federal Reserve, nothing to do even with Donald Trump. It's invariably to do with you. We all see the same markets. It's the trading outcomes that differ depending on our behavior and our edge. A critical part of that is to manage our psychological state well. So good mental conditioning and self-awareness are non-negotiable performance drivers. We must put our hands up. If we made a mistake, own it. If we could do something better, own it. Because it's only through owning it that you can do something about it. So an example where this might be the case is that a trader breaks plan after reading a headline, a little bit of panic, a little bit of loss aversion perhaps, exit early, and then watches the price target hit just a few minutes later. The final one of our five that we're going to cover today is all about management of risk. Position sizing depends on how our edge scales or self-destructs. If we risk too much, that variance could ruin you. If we risk too little, gains may be meaningless. Sizing should match both our system statistics and our psychological comfort zone. And scaling must only occur on a strict criteria. And that can only be determined through measurement of a critical mass of trades, as I've covered before. A trader with a positive expectancy system blows up by risking 10% a trade after just a few winners. I've seen this time and time again in my life as a trading coach. Remember to be patient. If you can do the right thing, produce evidence of your edge over multiple market conditions, over multiple strategies, then that puts you in a great position to start to scale. But scale incrementally. There's a massively strong argument for variable position sizing, which again, if you move into an advanced level, perhaps this is something you should have a look at, based on strength of signal, which we've talked about before, underlying market conditions, of course, and your current exposure. If you've got 7 FX trades open and 5 of them are yen crosses, then exposure in that one asset is far too great in most circumstances to give you a good outcome. Ultimately, it will bite and it will bite hard. So all of those things, as you move from an intermediate to an advanced level of trading, are critical. So that covers your 5 key things in terms of developing, maintaining, and improving your trading edge. Review the material covered today and make a choice to work on anything there that you felt resonated with you and what you might need to do next. Ask yourself this question: on a scale of 1 to 10, how big an edge do you think you have? And where would you like it to be in 6 months? And then put the things in place that are going to make it happen. I hope that's been useful. We'll see you again very soon. Bye bye for now. Trade safe and see you again soon. Bye bye for now.